All right. So right now, um, let's see, we're going to go over one of the strategies and maybe take a big look at the market also. Let's start by taking a look at the overall market, what's happening right now. Let's take a look at that first. Let's see. I'm going to change the share to, okay. This is the S&P right now, so let's take a big picture look. I always go through this. This goes all the way back to 2000, 2001. This red line is the 40-period moving average on a monthly chart. Each candle is 1 month of time. This is the S&P 500, and each candle 1 month is the 40-period moving average. And this line here is an 8-period moving average. So in most cases, most of the time, price will follow the 8. So this is when the market crashed in 2001. All right. 2 consecutive closes below this monthly 40 indicates that it might very well go lower, and it did. And then as we recovered, we're back above the 40, and price will follow the 8, whether on a daily time frame, weekly time frame, monthly time frame. Price tends to follow the 8. So, but I know some people have asked me about timing certain entries for maximum profitability, or when to buy on a pullback, or when, even with our trade signals. This is a monthly chart, but within the month, we have multiple daily chart trades going on. But if you look at the bigger picture, if you get like a daily chart buy sometime up here, if you look at the big picture, is it best to buy it here or look for buy that same exact trade after it starts pulling back down to major support? So you might miss a long trade here, but this trade that was valid up here this month might still be in play, because we can't be in every trade. So we might still be in play later on. So when it pulls back to make the support, then you get into the trade a little bit lower down and ride the bounce back up, ride the bounce back up, ride the bounce back up. So there are people who have asked me, well, can we look at intraday charts to find points to enter the trade? I'm like, that's just literally the opposite of what you want to do. You want to look at bigger time frames. If we trade on a daily time frame, so you want to look on a weekly and bigger time frames to find entries on pullbacks, not intraday time frames. That's the opposite thinking of what you should be doing. We're not day traders. And it actually helps you, that knowing the big picture lets you actually be able to get bigger moves. Going intraday, looking at time, no, that doesn't help you get bigger moves. That helps you, and I use the term, minimize how much you're going to actually make by, no, you want to look at the big picture, look for the big pullback, look for the big moves on a bigger time frame, not a smaller time frame. So every couple of months, we get a major pullback to the major support. This was our 2008 crash. Once again, 2 consecutive closes below the 40, and it continued lower. And this was in 2009, the recovery. This was the bottom of the market, the recovery, and it took a while to get back above the 40. This is 2010, and every couple of months, it will pull back hard to the 40 and bounce. It will pull back to the 8 every couple of months, but we'd have major pullbacks to the 40. See, all these are buying up. Every time we get a major pullback, there's a monthly chart. So within each month, there are daily buys going on. So whenever we see a daily buy and it's anywhere near this support level, you can know you can catch a really nice big move off it. So something to think about, because I've been asked about buying pullbacks. We got our buy signals. We stick with our signals, but there are better opportunities sometimes if you're not already in the trade. So wait for certain pullbacks. So this is a massive uptrend. Here's still the 40. Here's the 40. And every couple of years, it will pull back for major buying opportunity. When this pulls back, this is when you hear screaming in the news, the market's dropped 10%. Market's going to fall forever. Don't get caught up in that. Once again, this was 2020 when COVID and the market pulled back hard for 3 weeks. These 2 candles, really 3 weeks worth of time, and then it just exploded higher. Biggest rally ever. pulled back. We didn't get two closes below the 40, one close below, rallied hard, right back above. Okay, right in the 8. The 8 is something learned from John Carter and Hubert Centers. They're two of the major people myself and Becky learned from, and the 8 was period moving average was a major part of that. Buying pullbacks to the 8 and other major support levels. Here we are right now. We are right at the 8 or maybe right below it. So I'm looking for actually a little pullback here below this. But when we start getting a pullback, here's where everyone starts screaming, the sky's falling, the sky's falling. Just normal market moves. I'm actually hoping this drops a little bit lower. And that lines up as this moving average goes higher, price pulls back. I'm hoping this lines up so beautifully for our end of year rally. So that's what I'm looking for.
May I ask a question?
Yeah, Olga.
What chart are you using there?
There's a monthly S&P.
It's the template I meant.
It's not one you have. It's just it can be any template. Just put a 40 period moving average on it and an 8 on it. But it's just a monthly chart.
It's a monthly chart.
Yeah, but you can use any platform with a monthly chart and just put with a time frame and just put on a 40 and an 8. Simple. Let's see. Take a look at the Dow. That was the S&P. Take a look at the Qs real quick. The Nasdaq. It's actually fallen below the 8. I'm looking for a pullback. We might retest these lows. I'm actually hoping it pulls back because I am actually short on options on. I'm trading XLI for the Dow, and I'm actually short XLI. I hit my first target already. Got in at a better price than expected at a 45% return on the first target. So I'm actually. I tend to get in at better prices than expected. We went over that in some previous meetups, but 45% return to first target on options. And let's take a look at one more DIA for the Dow, and then we'll get back to the futures. And here is DIA, just pulling back. So nothing's in a big free fall. It's just normal seasonal patterns, and every couple of months the market does pull back, but when this major uptrend, and that major uptrend has been in place for a whole bunch of years now. Okay, major uptrend with periodic pullbacks to support levels every couple of years, and we will pull back again, and the news will freak out and say the market's going to fall forever, but just know it's just great opportunities when you know the big picture. If you're a long-term investor, you wait till the market pulls back anywhere to this uptrending monthly 40. You wait anytime till this pullback, anytime towards this pullback, and don't panic, because if you're a long-term investor, and I know some people on this meeting are long-term investors or have part of their portfolio in long-term, that's the buying opportunity, is anywhere pullbacks on this massive uptrend anywhere around the uptrending monthly 40. That's for the long-term investors. For us shorter term people, traders, we have our trade signals, and we also have ways of fine-tuning that for improved profitability, as we went over in the last couple of meetups on options. But today, let's look at some futures. So let's see who's in the room right now. All right. So today we're going to take a look at currency futures as we've been going along. I'm going to change the share. And go back to the handout for a moment. Okay, and if you take a look at the chat window, you see the link for the handouts and also where we have all the recordings for the meetups. All right, so these are all.
I have another question, and that is regarding what are the hours that the currencies trade?
3 p.m. Pacific to 2 p.m. Pacific.
Thank you.
So we usually have our trade signals between 2 and I usually send out an email sometime between 2 and 4 something in most cases. But you can review that type of stuff anywhere between 2 and 4. Best time to actually place the trades are somewhere between 3 p.m. Pacific and 6 or 7 p.m. Pacific. Reason for that, most of the world is quiet at that point in time. So there's not a lot of movement. So you have a chance to get your trades on very comfortably, because we enter with buy stops and sell stops. You can put your trade on very comfortably and then walk away. There's nothing else to do. Just put on your entry target and stop and leave. So
you don't really look at the volume being so low as a negative.
which volume?
The trading volume, the contracts being traded.
Well, at the beginning of the day, it's always zero.
Mhm.
Every day starts out at zero. So, and then it goes from there. If you're trading some of the micro futures, it's lower than some of the full-size contracts, but every day the volume starts at zero and then takes off after that. So no, not really, except for some of the maybe Canadian dollar micro futures is a little bit low volume sometimes, so you might see a few spikes in prices, but usually not an issue. Let's see. So these are the only futures contracts we're trading, and based upon feedback from the people we've been coaching, they really, really like trading the currencies because those have gotten the very best results, period. So based upon feedback, we've really shifted our focus to be on the currency futures and how to maximize profitability on those. And you're going to be seeing more strategies coming out, or maybe minor tweaks to existing strategies to get more profitability out of our existing strategies, plus introducing a few new ones. So stay tuned for that over the next few months. All right. We still trade the index futures, the NASDAQ, Russell, Dow, and S&P, but not as many of those strategies. But it's mostly the currency, since they produce the best results, most consistent results. So that's where we're going to focus our energy. It keeps us happy, keeps the coaching clients happy, and everyone is seeing really great results from it. So especially this year, which is ridiculously profitable. All right, we're going to look at one strategy in particular, the bear attack. Before that, I want to make sure people understand profitability. So we're going to be going over profitability of these strategies as a whole. Then after that, we'll look at the strategy in particular. Now, talked about how we overcame losses. Well, way back when, even going back as far as 2007, both myself and Becky, we had gotten to a point where we were trading very consistently, making profits regularly. It wasn't any issue. We were profitable traders after like 2 to 3 years of trading. We found our groove and it was going really well. And then during 2008, we did something just ridiculous, and we didn't want to take a loss, so we did the old, well, let's move our stop type of thing, and things just escalated in the loss column, and then we started justifying, well, the market can't possibly keep going lower, and yes, it did, and our accounts melted away. And it's a lot of the same story you hear from a lot of people. You allowed a loss to become too big. And we knew better. We had our stops in place. We knew what to risk. We knew when to go short rather than but something up here, we weren't ready to take a loss yet. We just weren't ready to take a loss. And we figured, okay, let's move the stop a little bit, see where support, resistance. And when we look back on that, and that ended up being our single biggest loss ever. And I'll show you, I'll go back to that on a chart and show you. And then 6A, this was actually an Aussie dollar. Let's see, 2008. I'll show you the chart that changed us. And after we lost so much money, it was like, what were we thinking? Because we all knew better. Okay. This is where we were long. Okay, just to give you a quickie on the These two lines crossing down would be our sell signal. These two lines crossing down would be our sell signal. These two lines crossing up might be a buy signal. Okay, so we
Could
were
you
actually long this market on Aussie dollar,
could you go
and we
back
should have been,
could you
yep.
go back a little bit back in time just to see what was the atmosphere at the time? Oh, okay, so
Yeah, just normal trading.
yeah, just go
Yeah,
back and
yeah, yeah.
a choppy thing.
So we were long, and our, but at that point in time, we had been doing really, really well. So we were actually trading bigger size trades. We hadn't taken a loss in like forever. We literally hadn't taken losses. So when it came time to actually get stopped out of a trade, because we were long, we had a good size position on, both of us, and we should have been going short here. But when the market was coming down to our stop loss, we were like, we didn't want to lose several $1,000s in one shot. But that was the plan. That's what the stop loss is, to keep you from losing money. So instead of taking our stop loss and taking our sell signal, we just moved the stop down. Well, we did the old, well, we got previous support levels here and that type of thing. We drew trend lines. We put on a weekly chart. We're going to have support levels. It's going to bounce and come back up. It never bounced and came back. It never bounced. It just kept dropping and dropping and dropping. And we got to a point where we're like, now what do we do? Because now the loss we should have taken is now 2 or 3 times as big and getting bigger. It was about this time when we went to the Traders Expo. And there we saw some people the people who we learned from, in particular, John Carter. And another guy, I can't think of his name now. He was actually at Options University, Ron Ianieri. Ron Ianieri told both of them what we had done and how we just screwed everything up. And they both told us ways to get out of this, not to get out of the position, but how to hedge it with another position to stop the bleeding. I was like, great, thank you. Now I know how to at least stop the bleeding until we can find a point where we can recover. But it gave us, this was knowledge you can't gain from reading. It's knowledge you can't gain from watching a video. It's knowledge you can only gain from people who have been there, done that with their own money, and they're willing to share that knowledge with you. And
Did they
John
tell
and
did they tell you to
Ron was
did
great
they
with that. Yep.
did they tell you to buy a short contract of the next?
No, they wanted to hedge it with interest rate futures. It was a hedge with interest rate futures. But what happened is that during this time, as volatility went up, as the markets were dropping, margin doubled and tripled. Margin, when we get into these trades, margin might have been $1,000-something a contract, 2,000 a contract. Now it's 2, 3, 4 times that amount. Margin went up so high, it basically tied up all the available funds in our account. So we could not put on a hedge, even though we now had the knowledge to hedge the account to stop the bleeding. All of our money is now tied up with margin on open positions. So this wasn't the only position we had. We had other thing trades on too. We were talking about that with options in the past. So I had option trades on that I had to deal with, but money was tied up because of margin. Margin went so high, it magnified, and I tied up all extra capital. So we couldn't hedge it. Ended up taking a major loss. The eventually just had to get out, because the first time you get a margin call from the broker, you freak out. It's like, what's a margin call? And then you learn really fast. And then it's like, we need you to like overnight us money like right away, wire it. And of course, I wired it because we didn't want to take the loss, lock it in, because we thought the market would turn around. So we wired more money to, at that point in time, Options Express was our broker, which became Schwab eventually. And we did everything wrong. So if we were following our simple plan, which we knew what to do, You're in a long position, your stop loss is hit automatically. And this crossover, these two lines crossing would have been our sell signal. And this could have been our single most profitable month of trading ever, ever, ever. Ended up being, and we weren't trading micro contracts then. There were no micro contract. We're trading full size contracts. Okay. Full size contract, $10 a tick. So we're talking thousands and thousands of dollars lost because we didn't follow our own plan. And that was a psychological thing because we didn't want to take a loss. Well, this helped fix our mindset real fast. Never did that again. You learn real fast after that first big loss, and we learned in an accelerated manner to follow your plan because the plan works. If we did what we knew we were supposed to do, it would not have happened. We would have taken a loss. It would have been our most profitable month of trading ever. Okay. So, and what we had also, and by the way, this comes up, we're going to be looking at this soon, but this pattern comes up all the time. The crossovers hits the upper Bollinger Band crossover. We always go to the top and crossover. And a red candle hits up a Bollinger Band crossover, hits up a Bollinger Band crossover, hits the upper Bollinger Band crossover, hit up a Bollinger Band crossover, up a Bollinger Band crossover. That might be a loss. Up a Bollinger Band crossover. All right, so this pattern happens all the time. Let's take a look at this is the one we're going to go over right here, and then we'll look at the plan. But okay, I want to go over profitability first, and then we were going to come back to the chart. But this is a pattern that happens all the time. It's one of the one we traded the longest, and it's still part of our trading plan. And we'll look, but this is, so what we learned from talking to people at the Traders Expo in person and watching their webinars and their online trainings also. Number one, learning from a school is different than learning from people who trade their own real money. Big difference, big difference. So when we went to the Traders Expo and we met people who trade their own real money, they give us information that you wouldn't normally get from a trading school and courses and stuff. So anything I talk about is based on trading real money, going through real experiences, and forward testing strategies. We don't just back test. Back testing is great, but you have to actually forward test, meaning trade the actual strategies with real money to make sure it actually works in real life. Back testing doesn't always work in real life when you trade it forward. There are reasons for that, but it does not always work, and for multiple reasons, okay? So forward testing, everything we do is forward testing. I'm going to switch over to a spreadsheet. I want to go over profitability, real life profitability, and then we'll come back, go through the strategy. I usually sometimes save this for the end, but I'll do it early on this time. Some people, especially newer traders, don't real fully understand or appreciate how money is made, how money is lost, and they don't understand a big picture. So they'll see a bunch of wins, get all excited. They'll see a bunch of losses and get discouraged and stop. And you have to know, if you know what to expect, then there's no surprises and your mind won't mess with you as much. A lot of this stuff is mental, psychological stuff that a few losses can just make you shatter your confidence. So what I asked Becky to do, and anything you see in little rectangles and spreadsheets, Becky does all that. I do not do spreadsheets. If you look at all my trades, you'll literally find they're all on little Post-its and stuff on my desk. And that's why I do everything for trading. I don't do spreadsheets. I write everything down on paper and then I transcribe it to my trading platform. Becky is the one who tracks all the trades and spreadsheets everything. So she keeps track of everything like that. So, and she's really good at that. So each month she updates this for all the people who we're coaching, all the trade status, the win-loss stats. We don't do anything less than 80% wins for currencies or for index futures. Well, let's take a look at this. So I had to put together all the trades valid since 2019. We actually have all the trades going back to 2003. That's available to us to look at, but just to share with people so they can do their own back testing and see what's what. These are the trades which became valid and the worst case scenario. On our trading plans, we give people the what if scenarios. What if you use this size target? What if you use this size first target? What if you use this size second target or first target? Or if you use this size first target? Will your win? What will your win-loss percentage be if you use this size target, this size, or this size? And how much money will you make or lose if you use a target this size, or this size? That's is what we put on our trading plan. So you have a couple of different, so you make a business decision which target you want to use and which stop loss you want to use, given the objective information. So what you see here is basically the worst case scenario. Each trade, we assume $1,000 is being risked, and we are risking 4% of the account. So we're taking a 25 grand account. This could be any size account. This could be a $10,000 account. This could be a $50,000 account. It could be 100 grand account. It could be $1 million account. Doesn't matter the size. We talk about percent returns, so keep that in mind. So this whole setup is very scalable to bigger size accounts and smaller size accounts. For this particular scenario, we're assuming 4% account risk per trade. If you go 2%, then you're going to see all these numbers reduced by 50%, basically. If you want to go 6%, increase all these numbers by 50%. So you can, but it's all, so it is all based on 4% account risk. So risking $1,000, we're going back to 2019, January, our very first trade's a loss. Lose $1,000. Next trade valid, we made a 25% return. Once again, worst case scenario, 25% return. Next one, 30% return, $300, risking 1,000, made 300 as the first target. That doesn't mean that's all you can make. It just means if you went all in and all out, no trailing stop, stuff like that, no position managers, all in, all out, that's the minimum or maximum, that's the minimum profit you can make. So after this first month of trading, which kind of sucked a little bit, you end up with a minus 5% return. That's risking 4% account per trade. So between the wins and losses, just first target only, all in, all out. If you're the new person who just started trading the strategies, after this month, you might be discouraged. You might stop trading because you're like, well, we just lost money. That's where having a trading coach comes in. That's where I have to work with you to understand big picture. Big picture. It takes 3 to 6 months to fully understand how all this stuff works. What we trade is what I call the end game. This is where you get to after you've been doing this for 2, 4, 6 years. And you've gone through all that day trading stuff, sitting in for hours in front of a computer. You've lost money, made money, lost money, lost money, made money, and you finally get to a point where you're making money very consistently in a very easy manner. This stuff takes maybe 30 minutes or less every day to go through and get your trades played, 30 to 60 minutes maximum. Okay, I don't even spend that much. I might spend 15 to 30 minutes at the most each day. All right, so this 420 is 42% return at the first target. Okay, minus 5% return. Guess what? The next month, 5% plus 5%. I always say each year expect to have 8 to 10, sort of have 2 to 3 losing months each year, negated by 2 to 3 winning months. The other 6 to 8 months will represent, or 8 to 10 months will represent your profits for the year. So these 2 months offset each other. Once again, we don't go for quantity of trades, we go for quality of trades. As you move along in your trading life, you don't trade more, you trade better quality trades, not more trades. You want to trade fewer trades, but better quality trades. This is 4% account risk per trade, okay? If you want a bigger number, then you go 6%. 6% is probably the max you should do because of margin involved. That's something that I have to go through with you in a little more detail, not right here and now. The next month, March, another 5% return, 5.4%. We're now plus for the year. April, kind of small percent, less than a percent, but profits, positive returns. And then the next month, one of those great months with no losses, 10% return for the month. June, usually have fewer trades in March, June, September, and sometimes December. There's no trades in December. So not as many offsetting trades in June, so we had one loss. July, another awesome month, 11% return. August, good. September is one of those months where we don't have as many trades. October, good. And November, good. We don't trade in December. When it's all said and done for the year, with a 25 grand account starting with, we made $10,000, a 40% return. If this was a $50,000 account, you would have made 20,000, 40% return. If this was a $100,000 account, you would have made 40,000, 40% return. If you wanted this to be a 60% return, then you make 6% account risk per trade. If this was 2% account risk, this would be a 20% return. If this is a 4% risk per trade, it's a 40% return. And if you want this to be a 60% return, then you would. So that's how you just work with the numbers. Your percent risk, exact same strategy, but follow the rules and you can increase profitability. Max, you're going to go with 6% account risk. That's assuming you got nothing else in the account you're trading. Or the other stuff in your account you're trading, then you have to leave capital available for that. All right. This is the big difference between how we traded way back in the day and how we trade now, is that this is a plan, a business plan that we can follow, and we know we will make money each year because as long as we follow our own rules. The key, unlike that thing debacle in 2008, if we had followed our own rules back then, and we know the rules, we follow the rules, it's just math and business and math. I can hand this to 10 different people, have them analyze it, and they'll come back with the exact same results that, yes, it works. I hand it to 100 different people. They're going to come back with the same set of rules. They're going to come back and say, yes, those are the numbers. And that's how we trade. Something has to be repeatable. It's not subjective. These are the rules. Here's the entry. Here's the target. Here's the stop loss. Here's how much we're risking percentage-wise, and everything just flows. Individually, people do all sorts of ridiculous things at times. Like, well, it's going to be 90% wins. So in this particular trade, I'm going to risk 80% of my account because it's 90-something percent wins. Well, guess what? You do that, and that'll be the one time the trading gods, it's like, hey, we got one. He's risking a whole lot of his account. He's breaking the rules. And that's the time they're going to get you. You follow the rules and run your business, your trading business like a business, and money comes. You start over leveraging and gambling. You're going to experience some big wins, but then you're going to lose it all. You're going to experience the big wins and then lose it all. So you won't see consistency. You will get big wins and you'll make a lot of money, but then you're going to lose a lot of money. So be consistent with your trading. Next year, 2020, COVID time. This is our single biggest, this was my most profitable year of trading for both futures and options. I had nothing else to do. Nothing else to do. This was my only real income in 2020 was trading, and this was great. The futures look good, but options looked even better. Okay, this was just one of those great years for trading everything. All right, January, great return, great for January, great from February, March. These are strategies we trade right now. So for my coaching program, these are all the strategies which you learn. All right. Sometimes you have a great month and the last week you give back a little bit. Still a 10% return for the month on account. For some people, this is how much you expect to make in a year. For most people, you can stop trading in April and be happy for the year because you usually average 10% return on your whole account in 1 year for most investors. We do that in a month, and that's normal. Okay, that's not abnormal at all. You can make 10% in a month. Some people are happy with that in a year. I think myself and Becky went to a presentation recently, and we still go to presentations just to see what people are doing. But if people got like a 5% to 7% return for the year, they're like, yay, I got a 5 to 7% return for the year. Great year of trading. I'm like, good for you, yay. And but we're not, this is trading, that's investing. It's different. So going through 2020, just a beautiful year of trading. I see we had one losing month, once again, negated by a winning month. You actually lost 11% this month, made 16 the next. At the end of 2020, here are the annual numbers, 65% return for the year on account. Okay. And that could easily have been a 90% return if you were risking 6% of account rather than 4% of account. If you're risking 2% of account, is a 30-something% return. Risking 4% of account is 65% return. Risking 6% of account, this would have been a 90-something% return. That's how you double your money. You don't just massively, no, it's very controlled risk environment. Trading, proven established strategies. And myself, I review this every afternoon for the strategies, and I email out to all the coaching clients. Here are the trades we found valid for the day, compare it to what you found valid, and go from there. So you're not on your own. There's a lot of strategies. So I don't expect you to learn all this stuff on your own just overnight. So I work with you for months and months and months till you got us all down. But I send out the trades every day so you can follow and place the trade. Some people are paper trading, some people are live trading, but trade. Try to get, even if you're just risking $100, $200, try to be trading as live as quickly as you can, because you will learn faster with real money than like with paper money. All right, so 2021, same type of results for percent returns. Okay. And at the end of the year, 60% return on the account, risking 4%. Once again, this could be any size account. We're assuming 25. This could be a 10 grand account. This could be a 100 grand account. Could be $1 million account. It doesn't really matter how big the account is. It's about percentage return. Same strategies, different size accounts. 2022, now we had two back-to-back losing months. Now, here is where, this is once again, this is what messes people up. If you're the new person starting trading these strategies and you start out with a bunch of losses, and I convince you, it's normal, and then you go to next month and you have a bunch more losses, the reality is most people will stop trading the strategies. I won't hear from them ever again. They'll just assume they purchased a program and it doesn't work. They start telling people, I got this program, I lost all my money. That's all you ever hear. Okay. That's normal. People do that. That's why I try to stay in touch with people when I don't hear from them for a while. What are you doing? Usually they've done something silly and lost money and don't want to tell me. They're embarrassed. So I encourage people to talk to me. If you did something, let me know, because we need to not do that again. That's why you have a coach, so we can help you with that. But these type of back-to-back losses can happen. Okay. And most people realistically would stop trading the strategies. That's why I need to be in communication with you. Let me know what's going on, what your concerns are, because the very next month, you made back everything you lost in just 1 month of trading. That's the way it works. Just consistency. So you're trading. You got, as the year goes on, you end the year at a 40-something% return on account. We don't have losing years as long as you're consistent with your trading. You won't take every single trade. Impossible to be in every single trade. But you try to be as consistent as you can. You try to take as many trades as possible. And the numbers work themselves out. You try to take as many as possible. And when you have the currency futures with also as micro futures, you can risk as little as $100 to place a trade. You can get one contract, risk $100-something, and you're good. So there's no reason to not trade live, because if you can't risk $100, you shouldn't be trading. Okay. If you can't risk $100, this is not for you, because you should not be trading. So I'm serious about that. You got to be willing and able to actually risk some capital, even if it's just a little bit of money. You got to trade live to learn how to do this properly. You got to use real money to learn to do this. 2023, same type of results. It's just very consistent trading with the strategies. At the end of the year, 58% return. 2024 has been just another magnificent year so far. Through August, we're at 43% return. And once again, these are all worst case scenarios. If you look at the plan, you're going to see different choices for targets and stops. And this is basically the worst case scenario. You can actually make a lot more. You can trail stops and catch bigger moves. So I wanted to show you first how money is actually made when we follow a plan. No major losses that freak you out, because as long as you know you have a plan that's going to work, losses will happen. No matter how good your plan is, expect to have, at some point in time, you will have 3 to 5 losses in a row. It will happen. No matter how good a system you're trading, you will have 3 to 5 losses in a row. And you have to know that whatever you're doing will overcome those 3 to 5 losses. That'll learn first from Jake Bernstein, them other people also, as you talk to them who trade their own real money. Those type of things happen. Just the luck of the draw. I showed you 5 years worth of data approximately, and those 3 or 4 losses in a row only happened a couple of times. But when those couple of times happen, it freaks you out a little bit, and but it's a normal and expected, but it happens once in a while, guaranteed. All right. Any questions so far? And I want to get back to the plan if there are no questions. Feel free to unmute and ask questions. If you raise your hand, I won't see it, but you can type it in the chat window, or just unmute and ask any questions you want. So this sample trading plan is in the handout. Olga?
Looking at the chart with the Bollinger Band, what have you learned about the Bollinger Band?
Well, we use the Bollinger Band in different ways. I think, as you know, from the option trades on the ETFs, we use it in a similar way with the futures. Like if we have our trade signal that's closing above the Bollinger Band on our signal day, then that day is pretty extended, and there's a good chance it'll pull back before going higher. Or in futures is even more important, because we don't have the luxury of being able to hold a trade through a pullback, because it will hit our stop loss. So we don't take long trades that close above the upper Bollinger Band. And depending on the setup, we may not take trades closing below the lower Bollinger Band, depending on the setup, because that's a 2 or more standard deviation move in one direction. And statistically, that market is set to pull back somewhat after that bigger move. So we usually, in most cases, do not take a move when our trade signal day is closing above the Bollinger Band or below a Bollinger Band in certain situations, both in options and futures. So that's how we use the Bollinger Band. As the market's gone too much, we'll wait for a pullback or something closing lower than it. We have breakouts too, but that's more, we do that on the weekly charts for shares, which you're not doing. You may not be familiar with those. Maybe we'll do one of those presentations one day, but it's been last time I did a presentation on weekly charts with shares was 2007 or 2008. We did that for, I think it might have been a Tops group back then. I think we did it for Tops with PJ, but it's been a long time. We did an EM. It was one of Jake Bernstein's type strategies also, but it was way back when. No, 2009. 2009 is when we did it. I still have a copy of that, but we haven't done shares. Most people didn't have an interest in it, so we didn't really do it again. People wanted to focus on options and other things like that. So let's go over this strategy. It's going to be a bearish cross in the trigger lines, and we'll go over that in a second. all of our trading plans, you'll see a lot more detail in the real trading plan that has all the criteria for every strategy for all the chart setup. So if you want to have to set up the charts on your own, I have all the parameters. When you work with me, I will give you the charts ready to go, whether it's, and this is all on NinjaTrader, which is free to use. So I will give you everything ready to go, everything set. All you gotta do is open the charts and it's already set up for you, ready to trade. NinjaTrader is free and pretty easy to trade. All we do is use it for charts. You actually place the real trades on whatever platform or broker you have. But we'll always see setup, trigger, trade management. Setup is going to be visually what you look for. The trigger is some confirmation, and the trade management is what I go through with you one-on-one in detail to actually profit from the trade. All right. And you'll see in the handouts, there's the sample plan chart. And I listed in here every Aussie dollar and euro bear attack sell trade since 2003 and the win-loss status. Okay. So 85% wins very consistently on both Euro and Aussie since 2003. So if you're going to be reviewing this on your own, trying to set it up on your own, you can use those dates to confirm that your personal setup matches ours if you're doing it on your own. What you'll see this, like I have an example of P&L. You'll see in all trading plans expected P&L. When we trade this particular strategy since 2003 on Aussie dollar, the P&L is 3.2. What that means is that since 2003, whenever we trade Australian dollar futures with this strategy, we've made $3.20 for every $1 lost. That's what that means. It's a 3.2 to 1 return. We make $3 for every $1 lost. You always hear some people talk about 3 to 1 return where you risk 1 to make 3. No, yeah, good luck with that. We make 3 for every 1 we lose. Okay, that's how we trade. That's how we've always traded. This is very high probability trading where everything is over 80-something% wins. We make 3 for every 1 lost. That's how we trade, period. And each thing on the trading plan will give you the P&L. So you know exactly. Some of them are ridiculously like make $7 or $8 for every $1 loss because there's so few losses. Okay, so that's what that will mean and that's information we give you that Becky calculates from all the trades that she goes back through time, and everything is documented, what to expect. And as long as you follow your plan, it works out very nicely, actually. All right, I have a question. Trigger lines are based on Donchian and MA. Okay, I'll go back to the chart. All right. Let's see. So we're on the chart now. Okay, this is from July. The trigger lines, this is plot 2, plot 1. In a bullish cross, this is plot 1. In a bearish cross, this is plot 1. So plot 1 crosses above plot 2. Plot 2, this is a linear regression line. Linear regression line. You're going to find it on almost every analysis platform. Linear regression line. And this is a moving average of the linear regression line. So the moving average of the linear regression line crosses above and below the linear regression line, but it's a moving average. In this case, I believe this is an 8-period moving average of the linear regression line. 8-period moving average crosses below the linear regression line. 8-period moving average crosses above the linear regression line, and it's 8-period moving average off the linear regression line. That's what the trigger lines are. Okay. The most platforms will have a linear regression line, but not the moving average. You want the moving average, that has to be programmed. One of the guys in the group actually programmed this up for me to use on Thinkorswim. And so I have a copy for Thinkorswim. So we use that for Thinkorswim. This is NinjaTrader. I have that available for NinjaTrader 7 and for NinjaTrader 8. So, and for other platforms, if you don't have the moving average, then you can just program that up yourself if you have the ability to do that. All right, so what we're looking for is these 2 lines to cross, for plot 1 to cross below plot 2. So if you look at the numbers in right over here, plot 1 and plot 2, Here plot 1 is greater than plot 2. Here, because you cannot see if this cross with your eyes, you can't see if this crossed or not, because the lines are right on top of each other. So you literally can't visually see it. So you look at the numbers. In this one, they're equal. Okay. Here we have a cross. All right. So you always have to be aware of things like that when we just go with the crossovers. Let's go back another one. This was a valid crossover, but the order would not have filled. We can look at that a little bit. Valid crossover. Valid crossover would not have filled. All right, we'll take a look at the same scenario here and look at the numbers involved. So how we do this, if you take a look at the pricing, it's 4 decimal places. And this last place here, each tick, if it went up to 1.6674 to 0.6675, that's 1 tick. For a full-size contract, this is 1 tick is $10. For a micro contract, 1 tick is $1. Okay. For our purposes here, we're going to assume a micro contract, and to make the numbers a lot simpler, we'll assume a micro contract, so every tick move is $1. So when we have a bearish cross here, we're going to put our stop loss 10 ticks above the high of these 2 days, which is whatever the highest high in these 2 days is, our stop loss is 10 ticks above it. So the high here would be points. If you take a look at here as a data box, the high here would be 0.6765. So we put our stop loss at 0.6775, 10 ticks above the high. We only go short when the markets are actually going lower. So we don't just get into the open. The markets have to be actually moving down for us to get short. So we're going to put a sell stop to enter the trade 10 ticks below this low. So the low that day is 0.6708. So our entry would be 0.698, 10 ticks lower than this low. And our first target would be 40% or 45% or 50% of the difference between the entry price and the stop loss. If it's 40%, if our first target is 40% of the difference between the entry and the stop loss, that means our profit will be a 40% return. Okay, everything we do is daily time frame, always, always, always. So if we target 45% of the difference between the entry and the stop loss, then our profit will be a 45% return when the first target is reached. If our target is 50% of the difference between the entry and stop loss, then we will make a 50% return at the first target. We provide the win-loss stats and P&L for all those scenarios. So you'll know, like, okay, if I go 40% return, is going to be like an 89% chance of the target being reached, and here's my profitability, P&L. If I go a 45% target, then it might be an 85% wins, and here's my profitability. And if I go 50% target, it might only be an 83%, which is below which might be on the lower end, but might be 82%. So you might want, but all shows how much money you can make. So 50% target, you make more money, but you have more losses. So you have to make a decision which you want. You can have a smaller profit, a little bit smaller profit, but more wins. So you make those decisions given the information, and you accept the outcome. So what we do, if we're looking at this trade this day, you see, okay, nothing's valid. The lines didn't cross. Remember, visually set up, we're looking for 2 lines to cross. No trade valid on Aussie dollar that day. Next day, hey, did it cross? No, it didn't cross. It looked like it might have crossed, but it didn't. Next day, it crossed. You go through the plan, you see, well, okay, Aussie dollar, when I have this set up, I verified my setup's good, my trigger's good. then you see it's like 88, 89% winning trades when you follow the plan. So you take this trade. So what you see is right now, so I'm going to put my trade on. I'm going to sell stop 10 ticks. I'll determine how many contracts I have to trade based upon how big my stop is. Just for fun, real quick. Someone with a calculator real fast. Calculators, pull it out. Stop loss is 10 ticks above the high, 0.6775. I'm gonna write it down. 0.6775 is the entry, is the stop loss. ENT entry, ENTRY is 10 ticks below the low at 0.6698. What's the difference between those two numbers? Difference between 0.6775 and 0.6698. How many ticks is that?
77.
77? All right. At $1 a tick, that means for every one micro contract, you're risking $77. That's how big my stop loss is. 77 ticks, my 10 ticks above the high, and I'm entering 10 ticks below this low. And for Aussie dollar micro futures, it is $1 a tick. That means for one contract, I'm risking $77. If I'm trading bigger size accounts, this would be $10 a tick, and it'd be $770 risk for one contract. Okay, but for micros, it's $77 loss for one contract risk.
I have a question. What was the low?
The low is 0.6708 minus 10 ticks, so 0.6698.
Okay.
Would be the entry price. All right. So if we wanted to risk $1,000 a trade, how many contracts can we trade? Ken, if you want to answer again. $77 for one contract. If we want to risk $1,000, how many contracts can we get? Anyone with the answer? We're risking $77 per contract, and we want to risk max $1,000. How many contracts can we get?
Want me to say it again?
Go for it.
12? 12.9.
Okay. 12 contracts?
You can go 13 if you like.
Okay. So what's 13?
It's gonna be a little more than 1,000. I was risking 1,000 a trade.
13 times 77 is how much? So 77 times 13 is what?
It's 1,001.
1001. Okay. That's how you determine your risk and how many contracts. Now, if you know you want to risk $1,000 and this is 13 contracts, you can do that if you want all in, all out. You can get 13 micro contracts, but you're going to be paying 13 sets of commissions. Or you can get one full-size contract and pay one commission. Okay, so you got to be smart about that too with commissions. That's it. I know, so all I do is put in my entry for my order. My entry, I'm going to sell stop 13 micro, let's say go score 13 micro contracts at 0.6698. And when that order fills, it will trigger a one cancels other bracket order where my stop loss is at 0.6775 and my first target is going to be 40% of the difference. What's 40% of 77, whatever that is, will be down here someplace. So 40% subtracted from my entry price. So 40% of 77 or 45% of 77 subtracted from my entry price will be my target. That's all in one order. And the order has 2 days to fill. So the next day is when the order fills and my target is going to be reached within 2 days. So once you place the order, there's nothing else to do. You have 2 days for it to be filled. If it doesn't get filled in 2 days, just cancel the order. but that's how we trade. So you do all your analysis. This is none of this is day trading. None of this is sitting there looking things go up and down. All right. Analysis can be done for the daily chart. And
Eversley,
yep,
I don't know if you mentioned this, but in Thinkorswim, you can put a time for the order to be canceled, so that after 2 days or 2 sessions,
can
it automatically
can
cancels
you
the order.
put an order in on Thinkorswim to cancel on a particular day?
Yeah,
Okay.
yeah, you can do it at a particular day and a particular time. But you have, it's a couple steps you have to do. And if you want, I'll write it up for you and send it to you.
Post it on the group thing, because we need more people to post stuff on the group Facebook page. So if you think that'd be good for the group Facebook page, perfect place to put it, Ken. And share it with people. If you
The other
think
question I have
helpful.
for you, you mentioned pretty quickly, if are all the currencies basically the difference between the micros and the full currency? Are they all basically 10 to 1?
10 to 1, yes.
Okay, so anytime you get close to 9 or whatever, you need to think about just going to full maxi one for.
I found, talking to different people, we all have different rates we pay for futures that range anywhere from less than $1 per contract up to about $2.50 a contract.
Yeah.
We have the full range, is whatever deal you make with your broker. So that can add up really fast. So 10 extra dollars times $1 or $2, hey, 15 or 20 bucks is 15, 20 bucks,
Yeah.
I'm sure we could do something better with that money than give it to our broker.
I hope.
But anyway, this is how we do all of our trades, whether it's long or short. The calculations I just went through real quickly, that is basically the calculation we use for 80-90% of our trades, whether long or short. And some people automate it, some people use spreadsheets. I can do it like that in like seconds. I only have to do a spreadsheet. I can just calculator and my piece of paper next to me on my table here, on my desk. But I got a valid trade. I check my plan to make sure it's good statistically, it's all good to go. And then I come back, I put in my entry, target, stop. I put in like my entry 10 ticks below, my target 45% below the entry, and my stop loss is 10 ticks above. It's all in one order, place the order, and you walk away. And this same scenario happened this past week. This was on 9/3. And I am in this trade still. I placed this trade. A few people I know are. Ken, are you in this trade?
What market is this?
Aussie dollar this week. Did you take it?
I think so. Yeah. Yeah.
Yeah. Olga, are you taking this trade? Are you in it?
No, Eversley, I didn't take it.
Okay. So Aussie and Euro, I'll tell him Aussie and Euro are the best. So whenever you see me put out a trade with Aussie and Euro, you should know I'm going to be in it. They have those two currencies give you the absolute best results. So whenever they become valid, I'm taking those trades. The other ones are good too, but these are the best, especially with margin is reasonable. And everything. The volume is good. Everything is good. The spreads are good. Everything is just great to trade Euro and Aussie.
Everly, I'll just pass along this little nugget, and it's taken me a while. You already touched on it a little bit, but the hardest part is the mental game, is understanding that you have to take the trade. Just do your job, put the trade on, do all the steps, and then forget about it, and do it every time, whether it's a win or loss. Because it's like you say, it's all about numbers, and mentally, it just messes. I have the hardest time because when I get a loss, and I think they're all should be winners, and because of the numbers, but they're not, and it's just hard. It's a mental game. It just really is. That's the hardest part.
Yep. Thank you, Ken.
Oh, Eversley, I had a question for you.
Yeah.
I know you
That's it.
mentioned that September is one of the months that we have to be careful with these futures trading.
Yes,
Are we within that period where we
yes,
usually don't take trades?
correct. I sent it. Have you read my email for this weekend yet?
Not yet, no.
Okay, it says for this week and next week, trade at your own risk.
Okay.
Someone was talking to me about taking one of the trades that came up this weekend, and the trade is valid on the September contract, on Aussie dollar and something else also. I'm not sure the broker will let you open a new trade on the September contract after like today or after
Okay.
like Friday because it's rollover week. And there gets to be a point where they say no new positions to be opened on this contract. Only new position open on the Z contract, the December contract. So the contracts are not the same price. So the price you see on one contract will not be the same equal price you see on next contract. It's different. Okay. So it becomes confusing and things get thrown off. But yes, we're in that time now when we don't, it's not advisable to take the trades on rollover week or quadruple witching week. It's better to wait till after this week is over and next week is over and then get back to the futures. Options are still in play. Options are great. Do whatever you want with options. That's why it's good to be trading both options and futures. Like we will not be trading any futures in December.
Yeah.
December is just a losing month for all these strategies. You're going to get stopped out every which way. There's market manipulation, position manipulation, end of year. So there's no trading of futures, but options are great. So doing both, you're going to end up okay, but no futures.
Okay. Sounds good. Thanks.
Now you can if you want to. And what I say is if you feel you really want to trade, you trade your own risk, but I highly recommend trading much smaller positions than usual. If you usually risk $1,000 a trade, but you have a psychological need to be trading, maybe risk 100 or two, that type of thing, you know? So you're in it, but you gotta be smart. It's not the same risk as trading after rollover and quadruple witching. If you're gonna trade a lot smaller positions.
Yeah, that
Right.
makes sense. Thanks.
Cool. But yeah, the same thing going on right here. Frost down. I put in my order. It filled on the 4th. This should have been Tuesday. So this was Tuesday. And it filled on Wednesday, retraced up, and slammed down on Friday. So I expect my target to be hit sometime in the next day or two. Market opens this afternoon at 3 o'clock. Expect within the next day or two for my target to be hit on the downside. So this is the trade I currently have in progress on Aussie dollar short. And with same strategy. So like I said, this is about 90-something% wins on Aussie dollar, somewhere there with this particular strategy.
Wasn't the other one Canadian dollar?
Canadian dollar long or short?
Short, I think it was.
Canadian dollar short without a loss, but that one was stopped out.
Yeah.
I was talking to someone about that. And I did not take Canadian dollar short because remember on the plan, it was literally at the board. It was between the 5 different stop loss and target scenarios we have on there. 4 of them were below 80%. And one was just at 81%. So only one of those 4 target and stop situations were even just barely tradable per our plan. So I passed on this trade because it was just barely above the limit on 1 out of 5 trading scenarios. So I passed on this trade, but it would have been stopped out because it has a crossover. It shot down, didn't quite hit the target, but it went up and stopped you out. I think it went up and stopped you out, then came down. So that's what happened. Now, if you got into this trade in a timely manner, you got stopped out, then it dropped towards the first target.
I misspoke. It was a long position. It was because the trade was above the market. It went up activated, and then it dropped down and took out the trade.
Different, that was a different setup?
It was a sell to close on 10 stops above. I mean, it was a buy to open trade, I say.
Which strategy was it? Do you recall?
Not off the top of my head. No, I'm sorry.
Okay. Yeah, I'm not sure. I
I'll have to
know I
look it
didn't
up.
take any Canadian dollar long trades.
But it was a long
Last week.
position, and it was 10 ticks above the high. It went up and activated on the news, and then over the course of the day, it fell and hit the stop loss.
What day was it valid? Out of curiosity.
It was a squeeze play currency futures buy.
Squeeze play.
Squeeze play currency futures buy on the 4th of September, 86%.
Template. Load. Yeah, Canadian dollar?
Yes, sir. Could be my mistake. I mean,
No, if it's valid, it would have been at 81%. I didn't take the trade because I want higher. 81 on Canadian dollar. I usually look for higher because I don't like Canadian dollar as much.
okay.
I like Euro and Aussie. So when I see Canadian dollar, I want 84, 85% or higher. It's just my thing. It's still valid. It'll show up on the win-loss charts.
Yeah.
But I would rather see a higher percentage win rate for Canadian dollar. Just because it's Canadian dollar. It's not as, I'm trying to find the right word. If you went through all the plans and all the traits and all the stats, Canadian dollar is not as consistently over 80% as the others are, is what I mean. So when I see it, I want it to be a little bit higher than the normal 80% limit. That's for me personally. It's still okay to trade, but for me personally, I want to see over an 84, 85% wins for Canadian dollar.
I hear you.
Yeah, but that's me personally. But yes, this would have been stopped out, and this would have been a valid trade if it was at 81%. But like I said, it's more a higher number. But yeah,
And that's to me, that's the important thing. If it's a valid trade, if it meets all the criteria,
yeah,
then you put the trade on.
you put
And
the trade on.
if it moves against you, it moves against you. If it moves for you, more power to us.
That's correct. And it's September, so you're going to see a few more losses in September. So you have to be a little more conscious of what you're trading. Let's see, put this back on 20. What we're just looking at, we were looking at, okay, this, okay, here we go. All right. All right. Do we have any questions on this strategy or anything we've talked about for the day? For our next meetup, really want to get into the seasonal pattern that's setting up right now. This is the end of year trade. I really want to go through and get into that because the market is pulling back so beautifully right now to set up for the end of year. That's the trade we get ready for every single year. And let me see questions here that I haven't gotten to yet. Okay, got it. Linear regression of MA cross above the linear line is when you go long short. The linear regression line this particular strategy is a short strategy. We have different trade setups for going long. This particular one with these particular settings with this particular setup and trigger criteria works well short. It does not work the same way on the long side. We have different trade setups for the long side. We have there are zero trades we do, zero strategies we trade where taking a long trade, flipping it over and going short works the same way. It does not. Trading the market up and trading the market down are completely different. They do not move the same way. The same strategy that will make you a lot of money long will lose you money short. Okay. So there's different strategies and different approaches. That's why our strategies work so well. We have a grouping of at least 10 strategies when combined. So you saw that list I went through with a P&L. That's about 10 or more strategies when combined create that. We have, so if we take a look here, we have strategies that will get you in long down here. We have strategies that will get you in long as the trend gets more established. We have strategies that will get you in short up here. We have strategies that will get you in short once the market starts moving down. So we have different strategies that get you in at different positions in time on, so that's why we trade a grouping of strategies to get you in at different periods of time, because you can't expect to have one strategy that does everything. It doesn't work like that. If you, especially if you're trading on a daily chart and you want to have enough trades to be consistently profitable, you have to have enough trades no matter what. So right now our program gives you enough trades to be profitable and have enough offsetting wins and losses. All right, so I'm gonna go back to the handout real quick, and I always keep thinking this is gonna be a shorter meetup, but it always ends up running long every single time. All right, so anyway, if you're gonna set us up on your own, you have the dates. If you want to work with me on this, for anyone on the meetup right now, if you let me know by this coming Wednesday, I will take $200 off the cost of the futures coaching. So instead of $17.45, it'll be $15.45. Let me know by midnight Wednesday. I'll take $200 off. I do everything one-on-one. All details are here. If you're in the South Bay, I can meet you one-on-one if you want. I do like meeting in person if possible. Otherwise, good old Zoom. And like I said, everything one-on-one. And however long it takes. I always tell people you need to commit at least 6 to 9 months of trading the strategies to really get it. 6 to 9 months of consistency, and you're usually pretty good to go, because like I showed on when we went through the trades, during that time you're going to have a bad month, and you got to know how to deal with it up here and then keep going. But once you go through that and get to the other side, you say, oh, I lost a bunch of money last month. I gave that money back, but then I made it all back just by keeping trading. And you see, that's just normal flow of trading. Not every month is going to be a win, so you can't stress over it. Just have to keep trading and know you have positive expectations, just consistency. If you're interested in doing both options and futures with me, which is always really the best scenario, for this scenario, I will take $500 off the combined price. Instead of $34.95, it'll be $29.95. So I'll take $500 if you want to do both. Just know that it's not an immediate overnight thing. This takes time. This takes time. Whether you're doing options and futures or just the futures, it takes time to learn everything. That's why I don't rush you. Some people move quickly, more at a faster pace than others. I like one-on-one because different people I have to explain things differently to, because we all have different backgrounds. So I might have to find different words to explain something to, let's say, Ken, that I might have to use words to explain something to Olga or something to Lex, because everyone has different backgrounds. I got to find the right words to say things so that they understand what I'm talking about, and then to get a point across. So that's why I like one-on-one. It also challenges me to be one-on-one, because I have to think, okay, I want to make sure you understand this. So so I take personal pride in seeing you be successful also, and that's why I do stuff one-on-one. So anyway, we're gonna have to call this a day for this right now. If you have any questions, please email, call me. All my information is on the handout, and also the handouts are on the link I just put into the chat window. You can go to my website, has all the information there also. The links on my handout and also on everything I send you. And hopefully we'll meet up next month, and on maybe in 2 or 3 weeks, and go over option stuff for the end of the year. All right, you guys have a good day, and I'll talk to you all soon.